Welcome to the session on funding India's infrastructure. With me, we have Arun Sharma, Chief Investment Officer, Global Financial Markets from the International Finance Corporation, and Suresh Nichani, Vice Chairman, RootCorp. We're going to ask each of our two speakers to take a couple of minutes, tell us about themselves and their company, and then we'll start the discussion, and at that point, we'll have it open for questions from the audience. Arun?
Well, thank you, Jeff. So I work for the IFC. We'd like to believe most people know us, but that's not necessarily true, especially in New York. So let me spend a couple of minutes explaining who we are. The IFC is the private sector arm of the World Bank Group. So as a multilateral, we're owned by 187 odd member countries. We have the mandate of investing in emerging markets, specifically in the private sector on a purely commercial basis, but with an objective to create positive developmental outcomes. So we work in over 100 countries. We invest about $10 billion a year. We have a balance sheet of about $50 billion. It turns over fairly quickly, because we put about $10 billion to work every year in about anywhere from 350 to 500 projects a year. We're very decentralized, so we have local operations. We have, I think, presence now in almost 100 locations. Not all of them are large presences, but we have significant presences in a number of key markets around the world. On the ground, that gives us a fairly good handle on what's going on in the domestic markets. I myself, within the corporation, work in the financial services, capital markets, infrastructure finance area. But our business is much broader than that. So we have about a third of our balance sheet in infrastructure every year, which is a very high priority. Another third is in what we call general manufacturing, that ranges from cement to pharma to all other types of companies. And the balance is in financial services. That's banks, insurance companies, leasing companies, other types of specialized finance companies around the world. And as an institution, we have the flexibility to invest across the capital structure. So we can invest in equity, we can invest in mezz, and we can invest in senior. As a AAA, we have the luxury of being a very valued swap and a risk transfer counterparty. So we do quite a bit of that business on an unfunded basis. We have an advisory business that supports our customers in terms of knowledge sharing, and a lot of that business is funded by donors who see a very good use of their taxpayer money as giving that money to IFC to drive improvement in quality and skills, as well as knowledge in a number of sectors of economic activity around the emerging markets. So that gives you a little bit of flavor. We have about 2,500 to 3,000 people spread all over the world. I would say almost 60% of them are now in field locations. About 40% are in Washington, which is where we are based. And we are very active in, I would say probably we are the most active multilateral from a geographical coverage perspective across all. And we're reasonably successful. So we've made pretty much a profit all through more than 50 years of our existence. We've maintained successfully our AAA rating, which very few institutions have. Of course, partly that's due to our significant ownership by the larger developed countries. But we also have, I think, a very decent track record, particularly equity track record is very enviable. And on the back of that, we recently started an asset management company that manages a lot of other people's money. It's close to about $6 billion now, and it's growing very, very rapidly. Because we have been able to essentially have equity returns that are in the top 15 to 20 percentiles of most equity indexes around emerging market equity investing. Of course, finally, we are very, very active in India, and I personally am involved in that market, and particularly infrastructure, and we'll talk about that in the session as we go along. Thank you.
Thank you, Arun. Suresh?
Yeah, thank you, Jeffrey. RootCorp is a joint venture between Savills of London. Savills is listed on the London Stock Exchange, 25,000 employees, about 500 offices. and also between our firm, Nichani Group, which is predominantly into finance and real estate. We formed this joint venture about 6-7 years ago and took reasonable amounts of capital to India. So I'm going to be focusing more on the execution side, on what are the good things and the issues that we faced while being in India. I do see a tremendous scope, obviously, friend of India, see a tremendous scope in the future, especially with the new government that has come in May. However, we do have extremely mixed reactions, since 2008 until about 6 months ago or 3 months ago. Our focus is more on real estate. Cordia Savills, which we are a spin-off of, manages about $6 billion assets under management, but focused mostly on Europe. So Savills and Nichani decided that we're going to focus more on emerging markets, and now we're looking at the US also, outside of Europe technically. Taking institutional money from mostly Europe, Middle East, and America to India, although I think there are a lot of hurdles doing that even today due to various things mentioned from previous speakers, which I don't need to repeat. Several hurdles remain. We need several policy changes in the Indian framework. To list a few, I think my biggest observation in the last 6-7 years has been the need for a credible exit. I almost see, although it's not intended to be, I almost see India as a difficult place to get out once you put your money in. Either there are currency issues or there are local issues, which we can go more deeper into later. But not to use a very strong term, but it's almost, for those of you who are from India, it's almost like a Abhimanyu chakra, as they say. It's like a chakra is difficult to get your money out, but once you put your money in, you got to be really careful. And I think the answer I've found is control. I'm happy to talk about that a bit more. Reasonable control on the deals you do. Wherever we have had control, either personally as a family or in real estate investments, we have been able to do well. But if you don't have control, it's been an issue. So happy to cover a lot of those topics as we go along.
Thank you. Maybe we could talk a couple of minutes just about the nature of infrastructure investing and then make it specific to India. If we move the clock back to pre-crisis, as an investor, the two things I was trying to be sold the most was 130/30 funds and infrastructure. And since the crisis, I haven't heard from either of these marketers. It seems to have just fallen off the cliffs. So what's inherent about infrastructure investing that makes it not so desirable these days, at least in the US?
Well, it's a complicated question, and I could speak an hour trying to answer that. But I think since this is the panel is more of a India-focused panel, so I'll probably revert back to answering your question with more in the Indian context. I think and of course we'll obviously have some general implications in that response. It'll probably partly answer your more broader question. See, the issue about infrastructure is first, I think we've got to break it up into what type of investors. Firstly, are we investing in equity? Are we investing in mezz? Are we investing in senior? That's very important when you are investing in infrastructure, because infrastructure projects have certain characteristics that are quite different from others. One, that they're bigger ticket size. So you will have typically a large requirement for investment of money. And that has to be met with 2 or 3 responses. One is that you've got to essentially carve up the capital structure into different slices, into equity, into mezzanine, into debt. Otherwise, it doesn't make sense. The second characteristics of a typical infrastructure project are not necessarily real estate, but infrastructure itself. Generally, there is an official engagement or counterpart risk that is inherent in all these deals. So whether it's utilities, whether it's power, whether it's airports, whether it's transport, whatever it is, you'll probably have some form of government on the other side, either as a concessionaire, either as an off-taker, and certainly as a permission provider of different types. So again, the quality of infrastructure projects and their financeability depends a lot upon the quality of that particular counterparty, which is the government itself. That's the second part. The third part, or third factor, which differentiates is the tenor of infrastructure projects, because they involve a lot of money and they involve a lot of, I would say, initial upfront work to get these things going and then generating cash flows. So these are essentially long duration projects. So when you have long duration projects, if it's equity, it's all right, because equity by definition is a long duration asset, or can be. But when it comes to debt, it's not so easy, because for long duration debt, as we have the unique example of the United States, you really need macroeconomic stability. You can have as many conferences as you like on debt markets, on capital markets, on fixed income. But it's all no good till you have macroeconomic stability, because unless you have macroeconomic stability, no investor worth his money is going to put a penny into a long duration bond. As simple as that. You don't want to be caught dead in the water by inflation and a response with interest rates. I mean, we're already just talking about an increase by the Fed in mid-2015, and all the fixed income investors in this room already are quaking in their boots. What's going to happen? Where am I on the duration curve? What's going to happen to me already? And we are really at a really low end of the interest rate, and we all know that if there is a hike, it's going to be a very little hike. So if you're going to get a small increase, there is so much trouble. You can imagine an emerging market where the volatility is that high and the macroeconomic stability is not there. It's so hard to get anybody to invest in long duration debt. So I would say these are, broad outlines of the differentiation of a typical project or a typical financing opportunity you have versus infrastructure projects. And of course, finally, I would say that there is a level of complexity, both from all these factors I mentioned and from the fact that because the deals are big, there are multiple stakeholders involved. So there'll be other counterparties, whether in different parts of the capital structure or different parties in the same capital structure. So with those kinds of complications, so you need expertise. Right? You can't learn this on the job. And this is not for the rookie investor. So if you're going to be investing in infrastructure projects or financing infrastructure, you really need to know what you're doing. And you need to have domain expertise before you want to go in there. And you have to be very careful about the risks you take, which may not all be financial risks. There are a lot of environmental and social risks. You have invest in a mine and it poisons the local native population from a leaching of one of the chemicals used to, for example, purify gold. What do you do then? So the things like that that matter a lot too. So expertise requirement, the complexity is very, very, I would say, significant in infrastructure projects relative to other types of financial assets that you may contemplate investing. So I think I'll stop here in terms of a general response to your question of why has the pace of, I would say, infrastructure assets being available for marketing gone down in the United States? Well, the question, I think largely it has a lot to do firstly with, I mean, again, although this is off the topic, but since you raised it, I think I just feel obligated to answer to the best I can. One of the reasons is that after 2008, banks essentially pulled back a lot. Investors were obviously extra cautious, and that made project sponsors really take a breather, say, wait a minute now, I think this is not the right time for me to start the project because I really don't have the financing available. And I think that builds on itself. Something called sentiment, which all of us live and die by. And I think it takes some time coming back. Because again, because these are complex projects, they take a long time on the drawing board. They're trying a long time to get off the drawing board into a marketing presentation in an investment banker's hand. So I think there will be a lag. I think we will see more projects coming for financing, but I think the impact of the crisis does have a deleterious effect on the pipeline and the willingness of sponsors to go ahead. Now, that's not the case in all the markets in the world. There are other reasons why the investment pipeline is weak in other markets, but I don't think we have the time to get into market by market detail. But the pipeline itself, however, is fundamentally huge. It's literally unlimited, and as you even hear in the United States, President Obama and others from time to time talk about using infrastructure as a mechanism to spur demand. And not only the government, but others, including leading economists, say, well, this is one way to, it's more of a Keynesian type approach of creating demand, but which is true that infrastructure in this country is aging too, and there was a headline this morning in USA Today that we have a danger below our streets about gas pipelines aging and exploding. There was something in Harlem, I think, yesterday, where you need that investment in infrastructure to, and I think it will come as we go forward.
Okay. Anything to add? Arun painted a nice picture of how nothing will ever get funded in infrastructure. You can't use long-term debt. You need a vibrant stock market. You need expertise that doesn't exist in a lot of countries. So what do you think about the future of funding infrastructure?
Well, as it relates to India, I think it's going to be difficult, to be honest. The goal is $1 trillion. I really don't see a credible plan from the government to reach that $1 trillion. I'm a friend of India, obviously that's why I'm here. But I think there have to be some major policies implemented, and I really don't see that much of an Indian leadership today at this summit, for example. So I've written a list of things. I mean, dependable exits. I think you got to look at exits even before you invest, and that's the very first rule of investment management. And I think there's a huge problem exiting from deals in India. Dependable policies, unwavering long-term policies, not something that is changed on the fly. Stable currency. Someone mentioned in one of the previous talks that India has a currency depreciation only of 1%. I would really like to see that math. How India has a devaluation of only 1%. I mean, I know that a lot of institutional investors and big Wall Street firms got walloped in the last 5 years. People, and in fact, we also lucky we took only little money, but we had most of it sitting in Mauritius in dollars. But whatever money we took in did depreciate. So we decided to return funds to the investors rather than take a risk of investing in 2008. And from what people tell me, and investors thank me, saying I think that was one of the best things we ever did, not to invest at that time in India, because the currency has devalued from 44, 45 to about, it went all the way to 67. So I think a stable currency is extremely critical for institutional investors and any wealth managers or portfolio managers out here in the US. I also want to put a thought on control. I think I mentioned it in the beginning of my conversation. What I've seen, I spent a lot of time in India, by the way, and more as an American spending time in India, 4 or 5 years there. And I really fell in love with the country and its potential. I am originally from India, so that's a natural tie. But at the same time, control is extremely critical. I've read a data point which I'm happy to tweet about later on today, is that almost 60-70% of the exits have been forced to, people have been forced to sell back to the promoters in India. I don't think that's the right way to exit. I mean, you're not going to get value if you're forced back to sell to the promoter. So the way we are going to go about it going forward is that we are going to own the land, and we're going to have control over the main asset, which is the land. Now, getting the land itself is a huge problem in it by itself. You know, sitting in lawyers' offices, worrying about some lady who has a grandson who could sue you 10 years later. You know, that's the kind of issues we faced. So when I was called to speak on this panel, one of the things that I mentioned was, I think, to answer your question, Jeffrey, in a slightly roundabout manner, I think infrastructure, at least for us, seems to be a little bit of a reach, you know, 15, 20-year investments. We are focused more on, yes, we are happy to do special economic zones, which is kind of infrastructure, but at least you want an exit for investors between 5 and 7 years, maximum 9 years. And how do you achieve that? So we'll probably look at the smart cities being contemplated, projects around those smart cities or the new cities that are being built or old cities that are being reinvigorated by the government. Short toll roads, maybe there are exits there that you can build. You can get some reasonable exits in 5 to 10 years, you know, building infrastructure around these corridors that are being envisioned, like the Delhi-Mumbai Industrial Corridor or the Chennai-Bangalore, you know, highway. But I think we got to be extremely careful and plan out first. How do you get out from the, you know, from the investment? We do mostly equity investments, and we can do debt, but we prefer equity. What else? I think international arbitration is another area that I was talking to a developer friend of mine who was getting, well, taken to arbitration by an investor in Bangalore, and he just said, fine, we'll go to arbitration. It's going to take them a year to, you know, year and a half to even enforce it in India. So how do you really enforce arbitration in India? So I think these are all the cautionary statements I'm making, but overall quite positive about the next few years. Very eager to see what Mr. Modi conveys to the public, what policies are made to help institutional investors in this room really take a positive stance on India, but I'm yet to see that.
Does the audience have any questions? Okay, so we'll go here first, and then we'll go over here.
It's the ambitious target we have on infrastructure financing for India, and given the fact there's an absence of long-term debt market in the Indian banking system, do you believe these financial targets are achievable?
Okay. Well, they're achievable. I think not fully, firstly. I think that's going to be very, very difficult. I'll just give you a number. I mean, the total Indian credit needs are estimated variously between 180 to 200 billion, just normal overall financial system needs. The ability of the entire financial system, I'm counting all banks, non-bank finance companies, mutual funds, everybody combined, credit needs are around 110 to 120 billion a year. So there's already 100 to 80 to 100 billion gap every year in the existing, forget the new financing needs. So to say that you will have an incremental financing of $1 trillion is, yeah, it's a bit of a reach. I think we've got to be realistic about it. But, and it's also clear that the domestic savings are simply not enough to meet these needs. So we've already established the fact that we have a target. Yes, it's ambitious, but it's good to be ambitious because you've got to start somewhere. But it's also good to be realistic. But what is even more important is, well, to the extent that we can do the right thing, what is that right thing and how we should go about it? So it's not that the government is not trying. The government has tried, And unfortunately, the quality of that effort, and I wish Secretary Mayaram was there because we've been engaged in giving some advice. We wish it was taken. But I understand now it's being taken on board with the new government, which is an enormously, enormously positive sign. I think if the right steps are taken, then I think we can go a long way. And let me just outline 4 or 5 of them. First, the quality, see, infrastructure financing, despite all the things I mentioned, it can be an attractive asset, as it has been in this country, for 3 or 4 reasons. One, it's long-term, so there are lots of investors who need stable, long-term cash flows. Insurance companies in particular, pension funds equally so. So they would like to see long-term cash flows in their portfolios to meet the liabilities. So if you can generate, but to get long-term cash flows, you need a strong, well-structured project that can reach financial close, can reach commercial operation, and can benefit from consistent government policy which allows those cash flows to be generated as long as the project is performing. So that's the first. The second thing is that you need to be able to structure that project right in terms of the capital structure. What happens is that you have a cash flow payout profile of 20 years, 25 years, you're financing it with 5-year, 7-year money, and then you have refinance risk, and it can't get refinanced, and the sponsor gets into trouble, and then nobody gets paid. So that's the second thing. So you need to figure out that on day one, you have financing solutions that get you a decent debt service coverage on the project. That's what makes for a successful project. That's the second point. The third point is, look, investors around the world, much as they love India, are financial investors with a fiduciary capacity to their constituents. If Nichani has taken money from institutional investors, he's going to invest only when he's able to make the case to himself and to his investment community that this is the right risk reward for what I'm doing. And for an investor, I can invest my money anywhere. India is not the only country. I've got Brazil, I've got China, I've got Indonesia, I've got Pakistan, I've got Turkey. I can go anywhere. I've got Europe. So what the government has to realize, and I think they are realizing that, is that what we have to do is if we want to get investor money from different parts of the world, we have to offer a competitive value proposition. Now, what constitutes that competitive value proposition for an investor? Things that Suresh mentioned, for example. Things like an ability to exit, and a strong, stable cash flow, and a mechanism to manage currency risk, for example. Now, the last one is the most difficult one because, it's, as I said, it relates entirely to the macro prospects of the country to a very, very large degree. But there are mechanisms, again, that can be put into place to hedge currency risk. And despite the experience of investors who came at certain points in the cycle, there is now, at least at this point in the cycle, a great deal of bullishness. IFC has started a $2.5 billion rupee bond issuance program in the domestic market. We announced it on August the 20th, I remember. On August the 23rd, I got a call from a customer of mine, a very large insurance company in the US, asking for $200 million private placement on the next day. Of course, we had to tell them, look, it takes me a few days for IFC to issue, and clearly we have to distribute this asset to a wide range of, I can't just do a private ticket. But that's the kind of demand we're getting. So there is a lot of demand for long-term, stable Indian rupee exposure for certain types of investors. So it's already there because of the fact that the yields here are so low that, and the expectation of devaluation in some people's minds is that they are bullish, they feel the devaluation will be managed, and the 8-9% difference that they will have is more than sufficient to cover the devaluation risk. And these we're talking 15-year money, by the way, or 20-year money. So again, we need to find a way to be able to offer that kind of value proposition. Now, in terms of exits, I think that's a central sort of theme of one investor that we have. I wish we had more. That is a problem not only of one, but a lot of investors for various reasons. One is some investors have this problem because they can't get out, but that's really for sponsor reasons. And this is a typical private equity problem. It's not only in India, it's not only in real estate, it's not only in infrastructure. When you invest with somebody who has a divergence of interest, there's going to be a fight. It's by definition. So when we invest, for example, I'm negotiating a deal in Colombia right now with the government. And the biggest fight is on this issue. I need a guaranteed exit, and the government is not willing to put a contingent liability on themselves for that particular, and they have to go to the parliament and then now we're in the middle of drafting a presidential decree to allow the minister to sign the deal in that particular instance. So it's a real issue. But that's only one part of the exit problem. A bigger exit problem in India is the fact that sponsors in India are stuck. They're stuck because there are only 5 or 6 or 7 really sponsors with the kind of balance sheet to take on these multi-billion-dollar projects. And all of them are stuck because of a lot of other issues, not related to finance, but the operational aspects of infrastructure projects. Gas is not available, coal is not available, environmental permissions are not available, off-takers are not doing what they're doing, prices have gone from somewhere to somewhere, so you need to renegotiate them. So, I mean, I could go on to the list of issues.
Maybe we can get to the next question.
Yeah. So in sum, you've got to solve all these issues. But if you can, I think there is going to be a significant opportunity for international investors to come in, as long as I said, the Indian sort of private and public sector combined can offer a competitive value proposition. Sorry, that was a long answer, but then it was a complicated question.
Maybe my question is simpler. Arun, actually both of you could answer it perhaps. The Indian government has over time done many things to try to attract local financing for infrastructure. I was involved somehow ages ago on the IDFC formation. Now that's become a bank. There was another institution set up, the Indian Infrastructure Corporation Limited or whatever it was called.
IIFCL, yes.
Yeah. And that's moving along, and the government has been talking about allowing funds, infrastructure funds, and even considering guarantee companies. But really somehow the issue of the maturity profile of the investor versus the maturity requirements of infrastructure projects remains an issue, as the other gentleman has said, for foreign investors, as I'm sure for domestic investors. What is the solution in terms of better capital market instruments, institutions that Indians can create themselves and that others can help them create and invest in?
Okay, well, if I can answer that one, well, I guess one part is I think I can add our contribution. As I said, we have specifically to address this issue, IFC started a program of onshore rupee bond issuance. So we have announced $2.5 billion issuance. And the whole purpose of that is to issue 15, 20-year bonds. So investors in the United States can take our AAA, global AAA risk, but get rupee exposure. So it's a very creative asset class. And then we will take the infrastructure project risk because we know how to do it. So we in turn will downstream that money to different projects and go from there. And if we can do it, eventually, we hope that people like IDFC and others will also be given the permission, because what the government wants is to have a success first. So they want to have a success in terms of the fact that this bond issue is successful, so they know that if IFC goes in there with this global AAA rating, investors, if they have interest in this asset class, will buy. So this is a relatively safe way of floating this trial balloon. So that's one thing. I think our first bond issuance is going out in the next week or so. And so that's one solution. The other solution is to push the maturities in the domestic market. And there are a couple of programs. We don't have time to go into those programs, but we're very, very deeply involved in those programs that are structured around creating fixed income funds of different types. Unfortunately, and they've been around for 3 years, and they were completely, I would say, flawed. And IFC had advised the industry, and I'm not saying only the government, the industry, the domestic Indian industry, had got it completely wrong. And in fact, we had mentioned to the industry that, look, you will not get a penny from any institutional investor on these programs. And that's exactly what happened.
Yeah, I'd like to give
Sure.
Suresh the last minute for any comments you want to add.
Well, if you have a minute, I think the conclusion is, I think there's a lot of scope, genuinely. And as long as there are proper, dependable, enforceable structures put in place, and the right kind of financing, as Arun mentioned, for infrastructure, it has to be. I've seen so many projects fail in India because it's a 10-year project and the bank has loaned the person just for 5 years and he just cannot get it refinanced. I've seen that play out many times in many investments. We don't do those kind of investments, and in fact, sometimes we are overcautious. So I think as long as the right people are listening to what has been said in today's and tomorrow's forum, I think there are some bright minds here from New York City and from the US. If the government is listening, I think they can surely enact. I mean, Mr. Modi has the determination to do it. So that's what we're hoping for. And that's the conclusion.
Thank you. That takes us to lunch, and join me in thanking our two excellent speakers.
Thank you.
Thank you.